Good morning, everyone. Welcome to this Wednesday, September 6th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be with you here for the next 30 minutes, checking out everything going on in the pre-market, what we can expect from today's action. We're going to get to the wrap-up of yesterday's action in just a minute. I do want to remind everyone that it is Wednesday. So Wednesday at Earnings Beats is a big deal, because at 10 a.m. Eastern, we do our live chat room, live trading room. So if you'd like to come in, check it out. If you're not already a member, we do have a 30-day free trial. When you go over to earningsbeats.com, just make sure you click on that free 30-day trial. We'll get you set up, and you can come in and join us today at 10 o'clock. We'd love to have you. Let's go ahead and take a look at what happened on Tuesday after the long holiday weekend. Really bifurcated action yesterday. Most areas of the market got hit, and I'll show you what I mean in just a minute, but let's get that screen up for you. There you go. Dow Jones Industrial Average finished down a little more than 0.5%. S&P 500 was down 0.4%. NASDAQ actually clung to some gains yesterday, finishing up about 0.1%. Mid caps, though, down 2.25%. Small caps down over 2%. Transports down over 2%. Groups that held us up yesterday: crude oil prices continuing to rise. The XLE energy stocks had a pretty good day, rising about 0.5%. But the key that held the market up, especially the NASDAQ, was technology, which gained more than 0.33%, and discretionary, which ended in positive territory, though just fractionally. Both those groups, they're very heavily weighted in the NASDAQ, still pretty heavily weighted in the S&P, though not quite as much as in the NASDAQ. But that really masked some of the weakness that took place yesterday. There was really a lot of weakness. Autos, not part of it, though. Automobiles helping also to lift the NASDAQ. Tesla had a big day. I think it was the top performer in the S&P 500. And the autos as a group rose almost 4%. Getting back up, holding so far that 20-day moving average, trying to get back up through the 50-day moving average. So all in all, pretty good action there on the autos. Software continuing to rise. I wrote about this group in our daily market report yesterday. I think it's getting a little stretched. And if we do get back up near those recent highs, I would be a little bit more cautious with the software group, especially going into the fourth quarter of the year. Not the best quarter seasonally for that group. One group that I wrote about last week, really having big concerns with, even though it was in the top 10 industry groups from last week, home construction, very stretched. Talked about the possibility. It wasn't whether or not home builders could go up or down. It was about the risk of being in the group. There, I thought there was considerable risk. The group was down over 5% yesterday. Big push to the downside. So in this downtrend now, I see a head and shoulder, potential head and shoulder top. See the left shoulder, the neckline, the head, the right side of the neckline, right shoulder, almost perfectly symmetrical. If this group goes back down and breaks below 1,800, I wouldn't be surprised for a move back maybe 1,650 to 1,600 to the downside. So definitely a group to be careful with. I know home construction, home builders, they've been some of the best stocks out there, and for pretty good reason. I mean, we still, even though rates have been coming up, we've been in a low interest rate environment, but that's changed. We've gotten up into the fours. Actually, the many of the mortgage rates are as high as they've been in a couple of decades. So starting to see a little wear and tear on that index. Be careful with the home construction stocks. Anyway, let's keep moving because I got a lot to go over here. 10-year Treasury yield. Currently, it is down today about 2 basis points or so, 4.25%. But check out the reversal and the move back these last couple of days, last Friday, and then again yesterday. Really big move up from down around the 4.05 level, 4.06, jumping yesterday, and I think getting up to about 428. Let me see, 427. 427 was the high. Remember, 433 back in October, and then just recently, a few weeks ago, 435. So a double top, call it a cup if you want. Maybe we got a little handle. This breakout especially if it occurs in the month of September, could send us moving lower again. And I say could. I don't like to waffle. I like to be pretty convicted, and I am convicted from a long-term perspective. I believe the market goes higher. I've said that over and over and again. I would not be shocked to see 52-week and all-time highs coming up here in the next few months. But in the short term, I do feel like right now we're in a consolidation period. We've given no signs yet that we're breaking out of it. And we're in the month of September, and the worst part of September is still to come, the second half of the month. So I am not giving anybody an all clear sign yet on the market. I think short term, we still got some issues to get through, both from a timing calendar standpoint and also working through some issues from being so overbought, negative divergences. We got key areas that have been extremely stretched to the upside, home construction being one of them, semiconductors, one of the most important, if not the most important industry group in the market, extremely stretched. Going back 11 years, the PPO hit its highest level recently that we've seen at any point during the entire secular bull market. So if semiconductors pull back, you get home construction stocks pulling back, software reaches a top and pulls back. I don't think the overall market breaks out. I think what we could see is rotation, and that's really my main focus right now, is checking to see where the rotation's going, if we're rotating. Yesterday was a pretty good day for the bulls because technology and discretionary held up well, and because they are so heavily weighted. But again, this was not a good day yesterday on the market, as the mid caps and the small caps certainly could attest. As far as economic reports go, we have one key report that's coming out later today, and that is the ISM services number. That'll be out at 10 a.m. I believe July was 52.7, and August, which will be released later this morning, is expected to drop slightly to 52.4. But that's it, really, in terms of any significant economic reports. Not a whole lot in the way of earnings reports. We've got a couple of PPI or a couple of inflation reports, CPI and PPI, coming up next week. Then we've got the Fed. We've got the second half of September. This isn't quite done yet, folks. Let's not count on a breakout just quite so soon. I do think we've got to maybe negotiate some sideways consolidation, possibly even another pullback, maybe to test those recent lows. We'll see. Anyhow, moving on, S&P 500. You can see that pullback yesterday from the high that we saw on Friday. We got up to almost 45.50, pulled back. The sideways move may not quite be over yet. NASDAQ 100 also, going lower, showing lower lows and lower highs, but did actually finish slightly higher on the day, rising, as I said earlier, a little more than 0.1%. Volume, you can see, was very average at best, nothing major there. IWM on the chart definitely looks weak because we pulled back below those moving averages. But again, as I've said before, and I'll say again, when you go through a sideways consolidation period, these moving averages can be violated in both directions. Moving averages are key when you are trending. When you are trending up, normally the short-term moving average trades above the long-term moving average, and we normally see support off those moving averages. When you go sideways, like we did March through May, notice all the trips above the 20, back below the 20, above the 20, below the 20, above the 20, below the 20. Those trips above were not indications we were going to fly, and those trips back down beneath were not indications we were going to break down. They were meaningless. We were trendless. We were consolidating. Major support. Well, we could be in for some more of that right now, maybe through the end of this month. I'm not sure. Maybe we go right back up above the moving averages, or we've got some recent lows from 180 to about 182.5. That's, I would say, pretty key area of support in the near term for the IWM. But small caps, clearly an underperformer yesterday. Transports breaking back down below the moving averages and closing at the lowest level we've seen on the transports since the beginning of July. So that was not a great look there. If you're looking for maybe other areas to consider, This breakout here above this top, maybe closer to 15,000, might be a level to consider. But you can see on this bounce right here, the PPO barely budged back to the upside, and now moving back down, rolling over, setting new lows. So there are some charts here that don't look great in the near term. And as I mentioned, the overall market is in what I consider at this point still to be a period of consolidation / selling. I think that is the final period before we make a big break to the upside into the fourth quarter, but we do need to respect the sideways action for now. All right, let's take a look at the chart of the day for today. And so over at Earnings Beats, if you go over to earningsbeats.com and you scroll down, you will see our area where you can subscribe to our Earnings Beats Digest newsletter. Hold on one second. Okay. Right here, you can sign up for our Earnings Beats Digest newsletter. It's a newsletter that comes out 3 times a week, Mondays, Wednesdays, Fridays. They're normally out. Well, we try to get them out around 8:30. That's usually if I'm on time. If it's a little later than 8:30, it's because I'm running a little bit late on it. But usually 8:30 is what we strive for. We're looking for things that are important to us at Earnings Beats. So there's going to be a lot of focus on earnings because we do a lot of work with earnings. There's going to be focus on relative strength, candlesticks, price volume, seasonality, sentiment. All these things are part of what we believe constitutes the overall market and the way we read the market. So if you want to get more in tune with how we look at the market, there's probably no better way than to start with this EB Digest newsletter. It's a very quick read, by the way, 2 paragraphs in a chart and you're out. You can literally probably sit down in the morning, have a cup of coffee, take a couple sips and read it. It's usually that quick. So make sure you check that out. Again, if you want to join us at 10 a.m. for our live trading session today, right here, as soon as you subscribe or as soon as you come over to our website, you can subscribe by clicking on this no cost trial button. It's a green one right in the middle of the website. Can't miss it. Love to have you later today. All right. So what's our chart of the day for today? Well, I'm always talking about trying to catch stocks that pull back and maybe stocks that show reversing candles at key support levels. Well, I thought I'd show you the flip side of that from a bearish perspective. When a stock's been going up, but then potentially might be sending us signals that it's done for a little while. So let's take a look here at CF Industries Holdings, ticker symbol CF. And I'm going to annotate this so you can see a couple things here. Actually, also want to show you the relative chart, and we will annotate this. So the first thing that's pretty noticeable to me when I looked was we've been rallying off of this bottom. AD line been pretty good. So everything looking pretty good on the chart. We topped out right here at about 84. I think it was like 84.44. Pulled back, hit the 20-day, went back up, couldn't get through, and then we broke back down again. Now, maybe this is a continuation pattern of the prior trend, which was higher. That's what we look for. Whenever we're in an uptrend, we pull back. But there are some signs here that also suggest this may be the end of the line for CF. So I think we're at an important inflection point here on the chart. We had the breakout yesterday. Actually, the high we got up to yesterday was 84.44. So I'm thinking this other one was maybe around the $84, maybe upper 83s. So we got up, we went through, we had a breakout intraday, we had the volume, we were in an uptrend. It looked like, okay, here we go. And instead, market makers pulled the carpet out from the longs. We saw selling into the close, and we failed to make that breakout. Now, that is a shooting star candle where you gap up, you trade up intraday, and then you come back down and close at or near the lows. So think of it like an upside down hammer, if you're familiar with hammers. So this is a false breakout here. That's a reversing candle, and it is coming off of an uptrend where we had gone up for 7 consecutive days on CF. So uptrend in place, fails at resistance, reversing candle. By the way, the AD line has come down, even though we're back up at the high. Yesterday's candle with heavy volume, we were up 4%. AD line was down because we finished near the low. So there was a lot of intraday selling. I don't know. This one just makes me nervous. And then when you look down at the bottom here, the specialty commodities area, you can see underperforming the S&P 500. It's been underperforming since November of last year, and we just hit a 52-week low. So we're not in the best of groups. In fact, it's quite the opposite. We're in one of the worst industry groups. This stock is starting to show relative strength, but it is in one of the worst groups, and it did fail, reversing candle after an uptrend. Just want to be careful. Now, if we get through the 84.44 level, we've negated this candle. So it would be over. I'm going to just take a look pre-market. I have no idea. I haven't looked at CF. I don't know. I would expect a down day today, perhaps down to test that gap support at 79 and change. CF up right now, it's up 44 cents. So it's back to 83. We'll see where it finishes the day. But the level that it wants to clear on a closing basis is this open on this black candle right here. And that's at 83.82. So pre-market 83, close above 83.82, and intraday above 84.84 or 84.44. Those are the levels that I would be watching. If we can't do that, I think we're going back down first to fill gap support, test that 20-day moving average, and we'll see if it holds. If it doesn't, don't lose sight of this down here, which is that we are in a rough industry group. CF is in a rough industry group, and could fall right back into the overall downtrend that it was experiencing at the end of 2022 and throughout the first half of 2023. Let's take a look at some international groups. I haven't looked at international ETFs in quite a while, so I thought we'd start and go over several of them, maybe a dozen, 10 or a dozen, something like that. It's like I have 10 of them here written down. But let's start off with Brazil. And what I've done on all these charts is I've got the ETF for the international. I've got the top half of the chart representing that international ETF, and then the bottom representing how it's been trading relative to the S&P 500. So we've been in a pretty good bull market, nice advance in 2023 in the US. And so one thing you can focus on is where this relative strength line was at the beginning of the year and where it is right now. And you can get a sense of how well these ETFs, these foreign ETFs, have traded relative to the S&P in this year. I could just shorten it. Maybe I'll do that. I don't know if we need to see 3 years. I'm going to do a daily 1-year chart, so we can really just kind of focus on, and actually I'm just going to do year to date. So this is just showing you since the beginning of the year. There's the Brazil ETF. Here is the relative strength. You can see we're about where we were to start the year. So a little weakness on a relative basis, a little strength, been weaker of late, but kind of where we started. How about Canada? Got a lot of Canadians that follow the show, a lot of Canadians that are members at Earnings Beats. Canadian stocks have actually outperformed the US this year, at least the EWC versus the Spider. Or actually, no. EWC is up. The relative strength is down. My bad. So we are up for the year on the Canadian stocks, but on a relative basis, we've been trending lower throughout the year. Next up, China. So again, on an absolute basis, really just kind of flat. On a relative basis, China shares have been horrible relative to the US. Let's see, EWG. Let's take a look at Germany. Germany is up, had a very strong January. But since January, you can see it's been relatively flat. And as a result, EWG did pretty well versus the S&P because we did have such a strong beginning of the year in Germany. But since then, it's been a struggle. We finally reached a peak in late April, early May, double top. And since then, Germany's been underperforming badly. Next up, we'll do EWD, which is Sweden. Sweden, pretty much flat for the year on an absolute basis, up slightly. But again, since May, look at the downtrend versus the U.S. U.S. has gained a lot of steam once again in the past 3 to 4 months. EWH, Hong Kong, down most of the year on an absolute basis. So clearly, on a relative basis, not good. India has been pretty strong on an absolute basis. It actually struggled in January versus the U.S., but it's been holding its own since the end of January, actually up slightly since then. A couple more. Let's do EWI, which is Italy. Italy has been trending higher. It also did well until double top late April, early May. Struggled at the end of May, but it's actually bounced back a little bit. Been relatively flat the past few months. So Italy kind of hanging in with U.S. performance. Let's do Japan. Japan been strong throughout the year on an absolute basis. Strong versus the U.S. until June. But again, last 2 or 3 months, U.S. has been outperforming a lot of other areas around the world. EWU, this is the United Kingdom. Again, up slightly for the year on an absolute basis. On a relative basis, not so much. So earlier this year, I was talking about how it appeared that some of the international stocks were starting to outperform the U.S. and how we might be seeing a shift because the U.S. had outperformed for probably 10, 12, 14 years for the most part against most foreign ETFs. That started to change, and we could see that with a lot of these charts earlier in the year. But then all of them on a relative basis have basically rolled over, and we're seeing strength in the U.S. U.S. one of the strongest countries in terms of its performance, its stock performance. All right, I've had questions coming up about the Russell 2000, the IWM. And again, when, yesterday IWM was very weak, underperformed. Friday, it was strong. It outperformed. It was clear leader. I believe it was on Friday. Gave all that back and then some. There are a couple of ways you can look at the IWM. One way certainly would be to look at the IWM relative to the spider or to the QQQ. And you can see over the course of the last year, we had been flat for the most part heading into March. And then starting with March, it was really when the banks, we have a lot of representation from small to mid-sized banks in the Russell 2000. When the banks went down, so too did the IWM, not only on an absolute basis, but also on a relative basis. But since May, the IWM has been kind of holding its own versus a spider. However, versus the QQQ, of course, the QQQ has been one of the strongest indexes in the world. So just about everything has been underperforming. But you can see we topped back in November. When we were okay until January, trying to hold our own in February. And then March started the downtrend. But notice we're about even right now where we were at the beginning of June. So 3 months later, the IWM has basically performed essentially the same as the QQQ. So I know yesterday was a rough day, and we've had some periods over the last 3 months where we've seen strength. We've had periods where we've seen weakness. One of the things that I have liked about the IWM, and it's starting to turn a little bit, has been the intraday UDI. This is a proprietary chart that we developed at Earnings Beats to show what's going on an intraday basis. Forget about what's going on, including gaps, because there's a lot of manipulation that takes place at the opening bell. But what's actually happening during the trading day? And so one of the intraday charts that I've done a proprietary chart on here at Earnings Beats is the IWM versus the QQQ. And what you will see is that here, this includes everything. So with yesterday's not included on here, by the way. I have to manually input data. And so this was done as of Friday of last week, Friday's close. So it doesn't have yesterday, I suspect we're going to see intraday this move lower because IWM went down all day and the QQQ pretty much held up. So I expect we're going to see a drop here, but I want you to look at what the IWM was doing relative to the QQQ if we include gaps. So this is what you're going to see on stock charts. If you pull up the IWM QQQ going back these last few months, and I'm going to go back 4 months here. I don't remember how far I went back on this when I started. I've gone back at least 6. Okay, so you can see that all the way to the beginning of June, the IWM versus the QQQ was going down, and intraday, money was rotating intraday away from the IWM and into the QQQ. So my intraday signal was kind of confirming what we were seeing from the overall signal that includes gaps. But an interesting development has occurred, especially over the last couple of months, where we've seen this IWM versus QQQ go back down, and we're actually seeing it back down fairly close to, and I'm going to step this out one more day. Well, because I haven't put the data in, it's not going to let me. I wanted just to show you that this IWM QQQ had moved back down. I'll tell you, we'll go over here and do it here. Oh. Try this again. All right. So here was that pullback. I'll do a line chart, which usually with these ratios, I think line charts filter out a lot of the noise and all this other stuff. Don't really need. Let's just update this. So here you can see how we went back down, and we actually set a new low yesterday. The IWM versus the QQQ set a new low. This is what's not on my chart this one day, because again, I haven't updated my user defined index. So this came down right here to a new low. If I ignore the gaps, if I forget about what happens at the opening bell, look at what the IWM has been doing over the last 2 months. Now, you might say, well, yeah, but the price is still going down, so who cares? Well, this is something I talked about throughout 2022 with the QQQ itself, looking at the fact that it was gapping down, but it was rallying during the day. We kept seeing it go lower and lower. We had the retest in June, double bottom. We ended up going lower in October, but the chart that ignored the gaps was taking off to the upside. And so what it was telling me is we were seeing accumulation in the QQQ, even though prices were going lower. And it took a while for that to finally manifest itself into a major rally in the QQQ. So fast forward, because I'm getting members that are asking, I get this a lot, do you still like the IWM? Why do you like the IWM? This is the reason why. If we ignore the gap down, and the gap down, there's no volume. The gap down is taking news and literally just opening the market wherever it wants to, because there's very, very little, there's very little volume, very little liquidity. And so the first 10 minutes, maybe even 15 minutes, a lot of times you see this wild up and down action. And I really like to focus on what happens after that opening bell rings. Where's money going? Where's it rotating out of? Where is it rotating into? And what this chart is telling me is that over the last 3 months, money is rotating away from the QQQ and into the IWM, but it's being masked by gap ups on the QQQ and or gap downs on the IWM. So even if we see strength intraday, all we're doing is kind of bringing it back to even, if you will. And so if we don't look at just the intraday and we do include gaps, that's why we're seeing a breakdown right now in the IWM QQQ. Now, here's the dilemma, or here's the issue. If you call your broker and say, listen, I know my IWM's been going down, but I'm being manipulated. Market makers are doing this. I'm really not down that much. Could you put some more money back in my account? They're going to look at you like you're absolutely nuts. And you are, because the price is what it is. What we are seeing and why I like the IWM is because of what's happening beneath the surface of the price. And I don't know, maybe this will end up meaning nothing, but it meant a lot in 2022 when we saw the same thing, same type of thing happening with that intraday rotation into the QQQ. So I believe this means something. I believe from now to year end, not only is this line going to keep going higher, but I think this one's going to bounce back and go higher as well. So that's the reason. So if you've been wondering, why do I like the IWM? Why does Tom keep talking about the IWM? Why is he investing more heavily in the IWM? That's why. I was investing heavily in the QQQ when it wasn't doing anything last year. Had a lot of, YouTube critics and so forth. But at that point in time, what I said on June 16th or 17th, when I called the bottom of the market, what I said at that time was that it was not a guarantee, never guaranteed that we had a bottom. What I said at the time was there was too much risk to be on the short side any longer. That everything I was looking at was pointing to the market recovering. So at that point in time, I said, if you want to manage risk, you go long and you forget about shorting. That was what I said. And what I'm saying now is that if you want to manage risk, which is what I do, then I think you got to be careful with the QQQ and you want to be in the IWM on a relative basis. And that's why personally, I'm overweighted in the IWM versus the QQQ. So hopefully that helps explain. I know, like I said, yesterday was a down day on this. And trust me, I'm going to be watching this. This is something I'll continually update. This is something that will show up at least once every 2 weeks in the weekly market reports that we just started for our members this past weekend. So if you want to follow this, all you need to do is be a member. We got a 30-day free trial again. So check us out. Join us for the 10 o'clock live trading show. Follow our weekly market reports. We have daily market reports. We have who knows how many chart lists now that we have if you're a stock charts member and you're above the basic level. So if you're extra or pro, you can download all of our chart lists that we do, all of our research that takes us literally hundreds of hours. You can download like that, literally snap of a finger.
Hey, Tom.
Yeah.
I have a quick announcement. This is Erin Weber, VP of Operations at Earnings Beats.
Yes.
We are aware this morning that our website has been down and we're having some issues. So we actually have a very exciting announcement for everyone listening this morning. We're going to open up our live trading room to the public this morning.
Oh.
So for any members who are listening, you can get the Zoom link in the Earnings Beats Digest that went out maybe 10 minutes ago. And for anyone who is not a member, you're welcome to join us this morning, give it a try and see if you like it.
So if they're not a member, where do they go to? How do they get into the room?
It's working for you, the website. We haven't been able to get on it.
Well, this is static from earlier, so I haven't tried to do anything. I probably won't be able to do anything. But if they do get into the website or if they want to come in, how do they get in, especially with our website having difficulties?
So right now, the only way we've been able to send out the link is through the Earnings Beats Digest. So members and non-members would have to access the newsletter that went out this morning, and the Zoom link is inside that email. Okay. We will keep working on trying to get it on the website, but we haven't been able to do that yet.
Okay, if we get it on the website and the website comes back up sometime between now and, I mean, this will go until probably 10:45 this morning. So if we are able to get it up, if they come into our website and click on Trading
It'll be on the
homepage.
Live, on that page right there. Okay. So earningsbeats.com will have a big announcement for it that they can click on and access the Zoom link from.
Okay, so it'll be on our homepage. They don't have to click anything else.
Correct.
Okay, cool. Well, there you go. I wasn't aware, so that's good news for everybody. If you want to try us out, You don't even have to sign up, although I still encourage you to take out a 30-day free trial because we do a lot more than just trading room. But if you want to come in, just kind of get an idea. And actually, today's trading room would be a good one because while we're in September, and I do think we got to keep our expectations low in terms of trading success because we are in one of the worst months or the worst month of the year. One of the things I'm planning to talk about today is my routine and some of the things that I look at 10 o'clock in the morning. Some of the things I might do at 10:30 in the morning. Looking at the overall market, trying to figure out, okay, what types of trades would I want to maybe think about in this kind of an environment? So if that's something that's appealing to you, try to get in to our website. We're going to keep working on it. We've been having some issues this morning, but we are working with our host to try and resolve all these issues. Check our website out around 10 a.m. If it's up right on the homepage, everybody should be able to come in. So that's pretty cool. Thanks, Aaron, for that announcement because I really didn't know. So that's awesome. Anyhow, that's it for today. But what I do want to do real quick, just see what the market's doing. I know futures were down. I never even talked about futures, but they were down a little bit. Yeah, we got market down. Today we got the Dow down, S&P, NASDAQ's down. Small caps are up. So go figure. I mean, Friday, small caps led. Yesterday, small caps were horrible. Today, small caps are up while everything else is down. Follow that intraday chart, though, because I do think it's sending us a signal that we at least want to be aware of. Maybe you want to wait. Maybe you want to see the small caps break out first, which would be on the IWM above, say, the 200 level. We've had multiple tops. We go back 2 years. You'll see we've had multiple tops right up here at around the 199 area. If the IWM's trading at 200 or above, maybe that's when you want to say, hey, we got a breakout. And oh, don't forget Tom's chart over at Earnings Beat said money was rotating, and now we're getting the confirmation. Maybe that's what you want to wait for. I get in when my signals tell me to get in. And, I tend to have a lot of perspective, a lot of patience. And so that's kind of where I'm coming from right now. But however you trade it or however you look at it, completely up to you. Anyway, that's it for me. Appreciate everybody tuning in. Come join us at 10 a.m. Hopefully we'll get our website up and running so everybody can do it. But if you are on our EB Digest already, you do have a link in today's chart of the day where you can come right in and join us. Have a great day, everybody. Happy trading.